So welcome everybody to our bi-weekly webinar. For everybody that doesn't know me, I'm Ryan Poole. I'm co-host. I'm a real estate agent just like yourselves. I'm also the founder of RealTrade, which is an online marketplace social media platform for real estate where you can get free leads off your listings. Imagine that. Network with awesome service providers like Jim. And we're excited here. This has been a series that we're doing on the big beautiful bill and how it can actually save your clients a ton of money. We've had some great guests on this series, and this is the last of the series, so we're really going to dig in here to help you guys sell condos and sell investment properties to your buyers and help them save a ton of money on their taxes. So excited, Jim, for this one. Of course, my co-host Jim, for people that don't know, Jim Brown, not only is a real estate attorney, he owns his own title company, New Path Title, and the founder of the awesome closing software Title Leap. So excited for this one, Jim. I know we've done a series on this and you've had some great content, so we're excited for this show too.
Yeah, today's a really good opportunity for agents to cut and paste stuff that I've generated for them and literally just send this stuff out. I want to get a few housekeeping things out of the way before we launch into it. And then I also have I'm glad Alex is on the show. I also have some updated knowledge with regard to issues that everybody's been encountering. And Alex, people they text me, and the first thing they always say to me is, I'm sorry for taking your time. I know you're super busy. No, you guys, when you text me your problems, that becomes opportunities for everybody to get stronger. And that stuff literally, as soon as if you have a problem, I'm guaranteeing you there's 1,000 other agents with the same problems. All right, so crossing for cystic fibrosis. It's a long time from the event, but it's never off my radar, and keep it near and dear to your heart. These people are worthy causes. And so when you're thinking about your summer next summer, it's not too early. Think about crossing for CF. Um, Title advance. I've seen some recent title advances lately. I talked with an agent yesterday. They had a complex trust issue. Get your title advances. Text me when you read them. It just makes you a better agent. And we're going to decrease her runway to closing because of the things she called me about, which she never would have known had she not ordered the title advance. Like and subscribe, obviously. Our closing cost calculator, it's all updated for the SITS or NAR stuff. My goal in this podcast is to tell you guys what you won't hear anyplace else. So I have no problem being cutting edge, doing, saying what other people won't say, and sharpening the profession along the way for you guys, for all of us together. There are no dumb questions. And if we can stay a small group, if we do stay a small group and you want to ask questions along the way, no big deal. Otherwise, we'll do it at the very end. And if you turn on your cameras, I can see you for your responses. It makes my job easier. And text me 24/7 with anything I can do for you, whether I'm closing for you or not. And let's see, let's launch right into it.
Let's do it.
I'm gonna screen share, Ryan, and I'm working from home today. I'm sick. And so I'm going to ask you if there's questions from the floor. If you could just bring them to my attention, that'd be great. Or if
Yep.
people show up, if you could admit them, that'd be great.
Awesome. Yeah, and if you guys have any questions as we go through this, you can put them in the chat too as well. We'll get to them, as we go. I'm also going to share Jim's website for New Path Title and RealTrade as well.
Do
Awesome.
you have this stuff? Can you see the outline, Ryan?
Yep. Crystal clear.
All right, should I make it a little bigger possibly? 175. How you doing today, Fed? All right. One big beautiful bill offer Florida real estate agents one big beautiful opportunity. Today is September 9th, 2025. July 4th, one big beautiful bill was signed into law. We have another show providing more content. 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 Doreen's here, Ryan.
Yeah, I
Content
got
real
her.
estate agents that they can send to their clients to generate sales. Couple that with, oh my God. High income earners desire to save on 2025 taxes and Florida's condo crisis. This bill is a 4x multiplier of opportunity. You guys, people are already calling me about tax strategies for 2025 and how to save money. I know it's only September, but your high income earners, your salespeople, your doctors, they're already thinking about, and the timing is perfect to drop this stuff in their laps. They're already thinking about how to save money for 2025. This is part 3 of a multi-part show. Today we have more examples of the bill in application and cost segregation and tax experts to guide us. Zach and Fred are going to join us. They both said they were going to be a little bit late. The laws are always changing. There's Zach right now as we speak. Welcome, Zach. Glad you're here. We're still waiting for Fred. The laws are always changing. Make sure you're up on any changes. Text me 24/7. There's my number. You can also get me at newpathtitle.com. Click on 24/7 attorney support. If you like the way we work in paragraph 20, regardless of whether you're representing a buyer or a seller, in paragraph 20, write the escrow agent is, the closing agent is New Path Title. There is a difference between the escrow agent and the closing agent. And if your seller pushes back and you're representing the buyer, don't make that a hill to die on. But if we can close for you by writing us into paragraph 20 and you're on the buy side, leave the expenses on the seller side, and we'd love to close for you. All right, before we get to the OBBBA marketing stuff, I want to give you guys some tales from the street. So my goal here, there's Australia, always a pleasure. When I learn something new or I hear something of value through our law firm or our title company, we all get stronger. It's that simple. You guys text me 24/7 with all your issues. We can better the entire profession through this process. Whenever you call me, never start the conversation with, "I'm sorry for taking up your time." These conversations are the most valuable part of my practice. All right, so here's one situation Alex and I encountered, and it prompted me to do a lot more investigation into the laws and the trends and the things that are going on, and it gave me the idea for an upcoming show. So the situation is this: you have a multifamily or a multi-bedroom. I call it the multifamily or the multi-bedroom dilemma. The first situation is the listing says multifamily, multiple rentals, etc., whatever it might be, and the property appraiser's property card shows single family. The second fact pattern is the case number 2, the listing shows 4 bedrooms, 3 baths, and the property appraiser's card shows 3 bedrooms, 2 baths. What should you do? That's a practical problem. Everybody's seen it, and it's just happening more and more and more. The answers used to be easy. Lenders won't lend. Johnson v. Davis and seller's disclosures and unpermitted improvements. They're all in the contract. And all these rules still apply to your buyer today and your buyer when they go to sell in 3 to 5 years, right? So your buyer might be cool buying just like it sits. But what about when they go to sell, right? You have to think about your seller, your buyer is going to be a seller at some point, and you don't want them to have sour grapes or bad taste in their mouth from the transaction, and you don't want them to lose buyers because they can't get a loan or there's unpermitted improvements or whatever the case may be. However, today the analysis is not so easy. Lenders are way more permissive. Alex brought this to my attention. I started drilling down on it. It's happening in Miami-Dade. It's happening throughout the state. Lenders are getting more permissive. So that lender that wouldn't lend on the reduced bed count, they're lending on the reduced bed count, and they're figuring out ways to make it fit, even though it's actively used as a 4-3, it's only permitted as a 3-2, they're making it work. And many Miami-Dade houses have traded hands for years with unpermitted improvements. Like there's a little checklist. When your house has an unpermitted bedroom, you get the structural engineer, you get the plumber, you get the electrician, make a permit application, and you can get this stuff retro permitted. But here's the reality. A lot of this stuff is just trading hands time after time after time with unpermitted improvements. So like we had this ironclad framework for how to handle this stuff. It's just being eroded over time. I'm not saying those rules don't apply, but there's another dynamic coming in, and that's pad split and shared homes of extended families. It's all blurring the lines of what's in and outside the code. And so, I get the call a couple times a week and they just say, well, I'll tell them it's my mother, or I'll tell them it's my sister or whatever. Okay, I hear you. Here's Fred. Wonderful. I hear you. And we do have situations where Mom is living there with the brothers and the sisters and the grandkids and everything else. But there's plenty of situations we can all think of where they're just shared homes with all kinds of disassociated people renting rooms or whatever. And now layer on pad split, which is huge. Sorry, my screen keeps going dark. Pad split, which is huge in Miami, huge in Orlando. And I won't say it's a huge problem. I'm just saying it's something we need to be aware of. And so the best and easiest answer is always to disclose, 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 right? You'll never go wrong telling your clients what the law and the rules are. You'll never go wrong telling your client a statute. You'll never go wrong citing an ordinance. You'll never go wrong referring to your client to the appropriate professionals. Sorry. Even if they don't use them, you're never going to be in the wrong saying, I need you to talk to, at this point, you guys should talk to a lawyer or a CPA or whoever. You'll never go wrong doing that. And always remember, don't give an opinion. You're the conduit of information. Here's the statute. Here's a professional. Here's a whatever. Don't ever give your opinion like, oh, I don't think it'll be a problem. That's the stuff that I get asked to testify in expert testimony against real estate agents. Have I ever testified against a real estate agent? Absolutely not. Will I ever? No, I don't want that reputation. They are paying $500 to $900 an hour for me to testify against real estate agents, and I won't go.
Good for you,
But
Jim.
that's the stuff you want to put in the file, like here's the CPA, here's the structural engineer, here's the whatever. I mean, there's the three referral rule, right? You always give your client 3 referrals, but you're always going to be better off saying, here's at this point, you guys really need to talk to an engineer. Let me know if you want a referral. Takes 2 seconds. And our next show will have South Florida Pad Split rep Audrey McClintock, and we're going to talk about pad split, zonings, mechanics, and all of it. Even if
And I'm
you don't want,
excited for that one. I'm really excited for that. I mean, I know pad split. I have some, some good friends that are agents in Orlando, and there's investors crushing it right now with pad split. Crushing
and
it.
here's the reality, right? So there's a bunch of agents I talk to. Oh, I don't want to do pad split. It's not my market. It's not my this. It's not my that. That's fine. Even if you don't want to do pad split transactions, you need to know what pad split transactions look like, how they work, what the dollar values are. Why? Because you could be competing with your buyer or your seller or your something in the market, and the other property could be a pad split and you're not. Or somebody could be giving your client advice on a pad split and you're not. And so they're saying, why don't you tell me about this? And so these are the types of things you need to know about. You don't have to conduct the transactions, but you guys, knowledge is strength. And just like Airbnb, they will change the market. So you need to understand how. A lot of agents told me Airbnb is not my market. I don't want to know about it. The reality is Airbnb changed neighborhoods. I don't care whether it was your market or not. And if you didn't understand the Airbnb dynamics, you're just operating flat-footed. You're at a loss. And here's the other reality. We have a shortage of affordable housing in Palm Beach County throughout the state. I mean, throughout the country in a lot of places. So even if this stuff is not consistent with the current laws, it is filling in a necessary void. And if history is an indicator of the future, laws will bend to meet the needs of the community. It's just reality. And here I've been doing this for 40 years. And if I like try to look at this like I looked at it 40 years ago, where the laws were ironclad and single family was this and multifamily was that, and the future land use atlas and the zoning codes were set up a certain way, all this stuff would be unlawful. But the reality is we're softening around the edges to make this stuff fit because property is so expensive.
It's just the rents obviously have gone up, and that's why pad split is coming into the market, right? I mean, people can go in and share a 3-bedroom, 2-bath house.
And people just can't find affordable houses, period, end of
Oh,
story. All right.
bingo.
Number 2, this is just stuff that I've heard through the grapevine since the last time we met that I think you guys should be aware of. Be aware and beware And be aware of the new condo rider provisions. They do not look like what we are all used to and can bite an unaware buyer, seller, or even worse, an agent hard. We just had a file where the seller's agent knew the new form and how it worked. The buyer's agent either did not read it, did not understand it, or did not pay attention, and the buyer is liable for big assessments, money at the closing, right? So here's the new form. I put a snapshot in the outline. Here's the new form. And if you look at, if the condo, so there's two special assessment provisions, and one applies to special assessments levied before the effective date. Number two, II, applies to special assessments after the effective date. So what happened in our transaction is one of the agents, I'm assuming it was the seller's agent, checked that the seller would be liable before the effective date for all the special assessments, and the buyer would be liable after the effective date for all the special assessments. Well, if you're a buyer, do you expect that you're going to pay a special assessment that gets approved after you sign the contract and before you close? No. If you're a buyer, you expect that the seller is going to take care of everything until the closing, right? But if you're the buyer's agent who didn't pay attention to the contract, this could bite you in the butt if number two, they select buyer. And that's what happened in our transaction. And Tajay and I batted around the office for a while, and he just couldn't believe that it existed the way it existed. And the reality is, the buyer's agent's going to have a little bit of an awakening in this transaction. What's up, Alex?
Excuse me. In some cases, if I recall correctly, the HOA requires the seller to pay those assessments, and I think it's before effective date.
So if you look at number 3,
yeah,
they tackled that. They contemplated, like, this form this is the best form I've ever seen the Florida Association of Realtors and Florida Bar respond to changes in the law drafting. And so that exact situation that Alex is describing is contemplated, notwithstanding the provisions of 1 or 2, if any special or additional assessment may be paid in installments, and the condominium association will allow buyer to assume installments scheduled to be paid after closing, then seller shall prior to or at closing pay all installments which are payable on or before the closing date, check 1, and buyer or seller shall pay installments payable after the closing date. However, if seller is checked, or if the condominium association does not allow buyer to assume the installments, seller shall pay the special or additional assessments in full prior to or at the time of closing. So that situation came up a bunch of times for us as a title agent before this form came out. It hasn't come out since, and it's just something to know in the back of your head, but you as the agent have to be aware of what's going on. Now, the discussion is going to be coming, the discussion could turn to what's a special assessment and what's what do they call it? Special assessments or additional assessments, and then you can start, we've had discussions, well, this isn't really an additional assessment, and they try to recategorize it as something else, but they've taken regular reoccurring assessments and they've contemplated that in the paragraph above it, and then special or additional assessments contemplated in this paragraph, and you have to be aware that the contract form now handles pre-effective date and post-effective date special assessments differently. But it's a little bit confusing because in section 4, then like the old form, they say, hey, disclose what you know. But then it doesn't really give any legal implication for disclose what you know. It's just like, oh, it's out there, and maybe you don't, put it in there if not, and then it says here, right before the blank you fill in, if known. A special or additional assessment shall be deemed levied for the purpose of this paragraph 3 on the date when such assessment has been approved or is required for enforcement pursuant to Florida law. That's when everybody voted on it, and it's called ratified. Seller is aware of the following special or additional assessments that have been levied by the condominium association or discussed at the board meeting in the 12 months prior to the effective date. So for good faith, you're gonna fill that out. You're gonna provide the board meeting and the agenda minutes. And like I said, in a couple shows ago, there's actually 6 documents to be provided under that provision. And I had an agent call me the other day who sits on this podcast regularly and said, hey, what are the 6 documents? And I said, man, go back and grab the outline, because anyways. So it's resonating with some agents. There's a whole lot more work to do in condominiums. Be aware of the new form. Don't let it bite you in the butt. And I'm not sure. Is Taj in? I can't see the full screen, Ryan. I don't know if that transaction is closed yet or not, but regardless. All right, number 3.
Does that answer your question, Alex?
Yeah.
Awesome. Thanks.
Yeah, long-winded answer. Sorry, Alex. All right. Issue number 3 I want to talk about before we talk about One Big Beautiful Bill Act opportunities. Utility company cannot lien or charge the owner of real property if the utilities were consumed by a tenant. That is misunderstood so many times over, and I had a couple more calls this week on it, and I heard about it on other settlement statements and other title shops. I want to throw it out there. Florida statute 180-135. So if you're at a closing and the title agent's not us, or even if it's us, if you're at a closing and the title company has a charge on the HUD for utilities, and you know, talking to your client, those charges are from a rental tenant, it's likely not proper. However, the reality is the law does not stop utilities from making mistakes or even trying to get the money where they should not. And if the charges are for a couple of $100, the practical answer is, you know, you get dropped it on your lap last minute. How many sellers are gonna take the pain to go and get the stuff wiped? They just want to close. They'll ignore the couple $100, but you know, it's not right. And I've seen charges of several $1,000s. We had one a long time ago. It was a church, and the church had a tenant, and the tenant had several $1,000s. I think it was the tune of 37,000. It was a lot of money. Anyways, they ended up paying it. They didn't want to fight it. $2 million sale, but it's $37,000 the utility should not have had. However, the savvy agent knows the law and will speak up and shine in the eyes of their client. So you see something like this on your settlement statement. We're not the title agent. You bring it to your client's attention. Even if they don't go for it, they're still going to remember. Ryan pointed that out, you know, and he knew the law. And so when you see a charge for utilities on the settlement statement and you know that your client has a tenant, that's the brief fact pattern to think about this stuff under. Anybody have any questions?
That's good, Jim.
All right, main topic. Big income earners are already thinking about how to minimize taxes for 2025. I'm getting the calls. Fred and Zach are on the call right now. I'm sure they're getting the calls. And it's the perfect time. This is the perfect time to be launching advanced tax strategies to taxpayers all over the United States. I want to stress this. I keep getting calls from agents and they're asking me, we're talking about Florida taxpayers, right? No. Or we're talking about Florida buyers and sellers. No, we're talking about taxpayers, high income earners, anywhere in the United States. Here's a folder of marketing materials you can send out to get these clients to buy Florida property through you. Need a plural there. Please pick through what you like, redo, cut, paste, send, and repeat. All this stuff dated 9/9/25 was generated and updated for this show. The other stuff is old content. You're more than welcome to use and recreate. So I have an ongoing folder in this outline. If you go to newpathtitle.com and you click on the banner at the very top, you're going to see all our outlines. You click on this outline, you click on this link, and you're going to get a folder of content that I've put together. You just cut and paste it. Use it however you want. It's all pre-made. You don't have to go and reinvent the wheel. And to the extent that I can, I tested it with Fred and I tested it with Zach, and we've worked on this stuff together. Again, I don't mind taking some chances and giving you guys, for lack of a better term, cutting edge stuff. But this is stuff you're not going to find other places. Period. End of story. The stuff I'm telling you and the prepackaged marketing content for free, that's as high value as you can get if you paid for it. You're not going to get it other places. All right, here's the material I cultivated for today. Zack and Fred, I want you guys, can you see the chart of Ryan, can you see the list of documents in my Google Drive?
No, we're looking at the right now we're looking at just the outline. So maybe if you click the link and then it'll open up a new tab and then click over to the tab maybe.
So I click the link.
Yeah, click
It
that.
opens right up to a folder. I'm gonna stop the share and start the share. I can't even, because it doesn't open a new folder. So here's what the folder looks like. That's not what the folder looks like.
No, that's your Capital One.
All right, try it one more time. Here's what the folder looks like. Can you see the folder?
Hang on. Yep. Yep, we see the
When you
drive.
go in the folder, this is what it looks like. You got the One Big Beautiful Bill Act outline. I'll put the term outline in there so you guys can rename. And then here is the stuff that I generated for this show. Here's the short-term rental, passive, active loss outline content that you can cut and paste. And Zack and Fred are on with us. Zack and Fred, this is your opportunity to demonstrate your value and interject with anything that I'm not bringing, enumerating properly or whatever, but I'm sure you have hypotheticals and stories you can bring to light. Here's a ready-to-use marketing package for Florida realtors to share with taxpayers nationwide via social media and email campaigns, focusing on short-term rental I hate the term loophole, that allows high-income professionals, investors to offset active income. I'm going to change loophole.
So are you clicked on that, Jim? Because we're just seeing now just the drive right now on the. So I don't know if you can click that, if you can click it and open it. So everybody, I just shared the link to today's outline that has a link to the assets here that Jim's sharing right now. So you can kind of go through that as well on your own.
So I clicked on the one document that was talking about short-term rental convert to passive active gains. And so at the top, I gave you a little intro. Here is a ready-to-use marketing package for Florida realtors to share with taxpayers nationwide. I want to stress nationwide, you guys, this market is not people in your hometown. Via social media and email campaigns, focusing on short-term rental opportunities, on the short-term rental opportunity that allows high-income professionals, investors to offset ordinary active income. So, Fred, do you want to briefly describe the dilemma before I launch into discussing the actual post?
Yeah, can you guys hear me?
Loud and clear.
All right, perfect. Yeah, I was having some issues with my computer, so I had to join in through the phone, so that's why you guys can't see my face this time. But yeah, so
Fred's just I'll paint the picture. Fred's a good-looking young guy who is cutting edge on this stuff, and you're not going to get an old guy. I just hate to say it, I'm an old guy. You're not going to get an old guy or many old guys with the knowledge he has, and he sees this stuff with fresh eyes. This isn't like a change in the law. To him, this is just the law. Go ahead, Fred. Sorry.
So let me see if I could see these. Okay, so basically some of the things that Jim talks about and in the text that he's shared with you guys, or he's going to share more, is basically with the new Big Beautiful Bill, it essentially accelerates depreciation on certain properties. So the issue, what we're trying to do on most of these is we're trying to help offset high income earners' income, whether
So
they're
you have a
doctors.
doctor or a lawyer or an engineer or a salesperson or somebody that has active gains. They have W-2 income. They're making 500 grand a year, 300 grand a year, but they have a full-time job. That
Yep.
is what you're thinking about. That's your target. Go ahead, Fred.
Yes. So those would be the target individuals. So the most common one that I've worked with tend to be doctors. I think because they've been targeted a lot through like social media with this and stuff. So they have, let's call it 4, 5, 600,000 W-2 income. The W-2 income is called active income, and that is the income that is taxed at the highest marginal tax brackets. That's the one you're going to see. The top dollar is taxed at 37, 39%. So basically with some of these strategies that we're going to present is there's some, I don't want to use loopholes like Jim said, but there's workarounds. Maybe that's a better
I just
wording.
call them opportunities.
Actually, yeah, opportunities is probably the best wording. So there's opportunities where, normally losses on real estate are passive losses. So the way the IRS set up the code is passive losses cannot offset active gains or active income. But there's ways that you can.
W-2 income, that's active income. And now you bought Florida property, that's passive losses.
Yep. So there's ways that you can create those passive losses into active losses. And some of the workaround or opportunities that Jim is going to discuss help basically for your clients to be able to really do that. So I know, like, I don't think he's talking about it in this one, but one of the most normal ways is to be a real estate professional. That's basically 750 hours if you as the individual qualified for that. The other main way is basically to be a short-term rental. So the average stay at your rental has to be 7 days or less. But a lot of doctors, though, tend to not want to be that involved with their investments.
Now we're going to bring up 2 campaigns that are aimed at those high income earners and how they turn their passive losses to offset their active gains. And we're going to dive deeper into what Fred was talking about. There's two campaigns. Here's the first one. So unlock massive tax. So here's your social media post. Unlock massive tax savings with Florida short-term rentals. Did you know high-income W-2 professionals can save huge on taxes by owning Florida real short-term rental and turn passive losses into active income tax deductions? And then here's the criteria for your callouts. Property shall have an average stay of 7 days or less and 100 hours of involvement per year. No need to be a real estate professional to save, just document your activity. Enjoy massive tax savings in year 1, federal tax deductions via accelerated depreciation and cost segregation under the One Big Beautiful Bill Act. Florida offers no state income tax and booming rental demand. I don't drill down on that enough, right? When you're hitting all these people nationwide, Florida has no income tax. Ready to discover your next property and save big on your taxes? DM for details, blah, blah, blah. Fred, we're going to talk in a minute. This isn't this campaign, you guys, but in a minute, we're going to talk about spouses. And Fred, when we go and start diving deeper into the spouses exception or the spouse participation, I want to circle back on this campaign as well. So just remind me if I forget.
I want to add one thing too, Jim. When you talked about the income tax, no income tax, I've actually never pointed that out either. In Florida, there is no income tax. So all the properties that if they're buying properties in Florida, they're not going to have to pay state income tax on. A lot of the other out-of-state properties, so I've had some clients do this in California, we're able to save them quite a bit on federal income tax. But California, for example, they're not that investor friendly, and they actually don't allow the federal cost segregation in their state returns. So Florida is very advantageous because you don't even deal with that.
Wow. That's a great point.
I found that out recently when I was doing it for some California returns that they don't even, it's disallowed. They only allow straight line depreciation. And it's because they want the tax revenue, basically, short and sweet.
What's the doctor count in California? Florida has what, 19 million people? What's California? 3 times the size of Florida or something?
Yeah, I think it's like high 30 million or something.
Florida is 20 million, 24 million is the population, whatever it is. When I hear Fred talk about things like that, I just see opportunity, right? California doctors, high income, state income tax.
And I think a good thing too. So one of the clients that I dealt with is if as realtors too, you guys can explain to him how it's not that hard to invest long distance. You know, because he wants to be by a property now that he can drive by and see. But I know a lot of investors now, especially with technology, they're investing out of state, you know, because that's where they're getting the best deals. I know I've met people in Florida, they're investing in the Midwest, you know, for cash flow, things like that. So maybe if you connect with someone from out of state, try and explain to them the opportunities the cost segregation has in Florida.
And I know firsthand dealing with clients in South America, they were so content. They're so discontent to put money in the bank, and they're so content on buying US property because they can go to Google and they can see the property. They don't even care that the pictures are a little bit old. They go to the street view, they see the property. Like to them, that's the biggest sense of security they get. And it's just, we were talking about like an erosion of our past beliefs. It's just become part of modern life. Like a picture is worth being there in person almost, and certainly a FaceTime live walking through the property, you know. We don't have to beat a dead horse, it's obvious. All right, here's your email campaign. Save thousands of dollars in income taxes, buy Florida property. Dear taxpayer, want to cut your federal income tax this year? The Florida short-term rental loophole. Ooh. Opportunity. I'm going to refine that a little bit better before we post it. Is a powerful tool for professionals. Want to cut your federal tax? The Florida short-term rentals are an opportunity. I'll wordsmith that for professionals, entrepreneurs, and investors to dramatically reduce their tax bills and put real dollars in your pocket. Here's how it works. Buy a Florida property, rent it out for an average of 7 days or less. Spend 100 hours managing, cleaning, or improving your property annually. Use bonus depreciation under the One Big Beautiful Bill Act for year one tax deductions, no real estate agent license, and no need to be a full-time landlord. Here's an example. Physician earns $500,000 a year, buys a $350,000 Florida rental condo after January 19th, 2025, manages guest turnovers for 100 hours a year and claims $100,000 in active tax deductions. Puts approximately 100 grand in real dollars in their pocket in year one. For a $350,000 condo, a typical cost segregation study can reclassify 20 to 39% of the building's depreciable basis into 5, 7, or 15-year assets. Zach, if I say something wrong or there's something I could describe better on the outline, please don't hesitate to chime in, and anything you want to add, absolutely. Your input's valued. This means the first year accelerated depreciation would generally be $70,000 to $136,000 range. And more expensive condos yield bigger tax offsets. This doesn't just apply to condos, this is real property and condos, but again, the condos don't have land, and land you can't depreciate. So if you buy a condo, the condo has a bigger depreciable cost basis. Don't miss this opportunity. The Sunshine State is where it's at. Reply to this email or call us today to see valuable properties and start your tax savings journey. To see available properties and start your tax saving journey. Key fact bullets. This is for you guys, you real estate agents. This isn't what you share with your clients, but you can repurpose it however you want. But here's just a summary of how it works. And then I gave you was it not in this one? I gave you I gave you a case study. So here's your key facts. Property with an average guest stay, 7 days or less, lets you offset W-2 or business income. No Florida state income tax on rental profits. Florida maximizes your gains. Material participation, they have to have 100 years, 100 hours.
100 hours.
100 hours into managing the property per year. Do the math, it's not much per week. Condo prices are low. Oh, one big beautiful act restores bonus depreciation, claim the full depreciation immediately. Condo prices are low, poised for big price appreciation, and rental demand in Florida is at an all-time high. Maximize cash flow and tax savings. So these are call outs that you guys could use in your social media campaigns or facts that you can refer to. This is just a quick bullet point summary, but here is a campaign for, I'd love to have a quiz on this stuff, for how to reclassify active gains and offset with passive losses, not reclassify, but how to offset active gains if you're a high W-2 wage earner. This is advanced stuff, you guys. We have been building upon stuff we've been going over for weeks. So this is kind of like,
This is very powerful stuff. I'm actually copying. I'll be sending this one out actually.
yeah, well, if you're tuning in, if this is the first pod you've ever tuned into, you're going to be like, whoa, wait a minute, what did I miss? But there's a lot of stuff we went over early. Can you see my screen ongoing? Let's see. OBB1, there it is. Can you see my screen of the folder with the content in it?
Yep.
All
Yes.
right. So here is short term, let's see, non-income spouse. This is one Fred brought to my attention. I love this. I did so much research on this, trying to shoot holes in it, trying to figure out ways that it doesn't work, because I can't bring stuff to you guys that I haven't vetted. And 175.
Yep.
This one here, I have so many clients over the years. I used to be the attorney at First Citizens Bank, and all our clients were lawyers and doctors, and their spouses worked or didn't work or worked part-time in their business. This is freaking genius. And I had no idea it existed until Fred put it on my radar a couple weeks ago. And that's why I say iron sharpens iron. Here is a marketing package for Florida realtors to target high-income W-2 earners across the U.S. with non-working spouse, leveraging the real estate professional tax advantage for one-income households. I want to modify that by saying, just right up front, the non-earning spouse can work part-time, and we'll break that down a little bit more. But I think for the purpose of your social media post, you want to keep it simple. Maximize, so here's your social media call out, maximize tax savings and real estate professional status. Are you a high income earner with non-working spouse? You may qualify to convert passive rental losses into active losses that offset your income, reducing your tax liability, your tax bill significantly. Spouses filing jointly can use the non-working spouse as a full-time property manager. That's the essence right there. Qualify as a real estate professional by managing your rental property year-round and logging 750 hours. Turn rental real estate losses into direct income offsets, especially valuable for doctors, executives, salespeople, and professionals. I'm not even going to put the qualifier on there of 500 grand. Just high income. Doctors, executives, salespeople, and professionals. Period. End of story. Ready to unlock these powerful benefits with your next Florida property. Click here, DM us today. And here's your email campaign. Subject: how your spouse can help you save thousands on taxes with Florida real estate. Dear taxpayer, did you know that if one spouse is a high income earner and one is not employed or employed part-time and a married couple filing jointly, they can save massively on income taxes by buying Florida property? That's real money in your pocket today and an asset that appreciates tomorrow. Here's how it works. The non-working spouse manages your Florida rentals year-round and spends at least 750 hours on real estate activities. You file married jointly. You file married jointly, filing jointly, allowing rental losses to be treated as active losses instead of passive. These losses can directly, Fred, chime in if I say something wrong. These losses can directly offset your W-2 income. Great news for high earners like doctors, lawyers, salespeople, and executives. No need to be a licensed agent. Management, maintenance, tenant relations, and property improvements, and all count towards your hours. No need to be a licensed agent. Management, maintenance, tenant relations, and property improvements all count towards your hours. Example, doctor earning $600,000 a year uses their spouse as a full-time property manager. They convert rental losses into active losses, reducing tax liability, taxable income significantly. Ready to see how this strategy could work for you? Reply to this email or call us today for details on available Florida rental properties and tax savings. Everybody has their own unique way of doing things. This might be too wordy. This might not be enough. I'm going to dive a little bit deeper into, Fred, again, don't hesitate to chime in.
Yep.
I'm going to dive a little bit deeper into the non-working spouse that works part-time. The key rule for qualifying as a real estate professional for tax purposes is meeting both the 750-hour test. You must spend more than 750 hours during the tax year performing real estate trades or businesses in which you materially participate. And if you're working part-time, the 50% test, you must spend more than half of your total working time in real property, in the real property trade or business. So like many, a good friend of mine is a ophthalmologist. Who's the one who does eye surgery? Optometrist or ophthalmologist? Ophthalmologist, right? One of them works on eyes, one of them measures eyes. So he has his wife, she does the books, she does a little bit of work in the business. She's not in there day to day. She logs in a couple days a week, does the accounting, and she could do that and qualify as the real estate professional if they had rental properties and she did that activity in addition to her office management, provided she met these two tests. And they could turn their active gains. He makes a couple $1,000,000 a year working on eyes. They could turn their active gains. They could turn their passive losses offsetting their active gains. Let me say that one more time. Ophthalmologist, wife does the books. They buy property. She manages the property in addition to running the office part-time. They meet these two prongs in the test, and now his $2 million in eye surgeries can be offset with the passive losses first year accelerated under OBBBA income. So they're going to take the $350,000 condo.
I mean, just to be clear on this too, Jim, I mean, they could buy a property every year.
Right. And
Yeah.
so,
I just wanted to add one thing, Jim.
yeah.
So key thing for everyone to know is what you're doing to qualify is you're really using your non-working spouse under married file jointly. Because when you marry file jointly, you know, they really view both incomes on the return as like one entity. So you're able to qualify one person under the married file jointly as the, let's call it property manager or real estate manager who manages the properties actively. And, you know, to really make sure all your ducks are in a row with that, you can make like a log, something on Excel, Google Sheets, just showing, documenting, hey, when did I work related to this property? And basically that's how you're able to, because the eye doctor isn't going to be able to put 750 hours a week. But if you have a spouse that only works part-time, 10, 15 hours a week, then you can justify, I believe it comes to 14 hours a week is what you would need to show.
Exactly.
14 hours a week working on the real estate. And that's basically how you qualify under the married file jointly. It's actually a pretty good strategy because it is tough to get a lot of people to qualify if you're not married file jointly or you don't have a spouse in this situation.
And tying this back to the earlier discussion we had on actively managing properties. So we the first scenario we went over was you have a high intensity rental Airbnb, right? And Fred, this is a question I wish we had gone over before the show and we didn't, but I'm going to ask it live, and it's dangerous to always do stuff live. But could the spouse be the manager of the property and qualify for those 100 hours under the first scenario?
You saying for the short-term rental?
Yeah.
I think so, I believe there's no reason no that they
That's
can't.
what
It's
I
just
couldn't come up with a reason why they couldn't.
yeah, the only thing is what could get tricky that they could get challenged on is just the average stay. Because remember, they
Right.
need to
Right.
they still have to have like some sort
Right.
of proof, normally Airbnb or Verbo. I
They
think
have a
there's like a
log in Airbnb that you can get that quickly through.
yeah, yeah, there's normally something you could extract just showing that. So as long as the 7 day, the average seven, wow, sorry, the average
Yeah.
stay is under 7 days, they should be good to go.
So you've got married couple, one of the spouses is a high income earner, a doctor or whatever. They get a Airbnb, they rent it so that the average stay is less than 7 days. And now the doctor, the working spouse, the salesperson, the whatever doesn't have to log the 100 hours a year, 100 hours a year, 2 hours a week. The non-working spouse or the part-time spouse logs the 2 hours a week. They qualify for the 100 hours, and now they've turned the passive losses into offsetting active, passive losses into deductions offsetting active gains. I can't even wrap my head around the opportunities. I wish I was an agent because I'd spend my time marketing this stuff, but it's just exciting to me. Anyways, Alex, what's up?
So, excuse me. The talk was, one of the comments was California doctors because of the tax implications in the state. So my thought was reaching out to California realtors with whom I have connections and creating a marketing plan so that they can contact their doctors and funnel them this way. Once that happens, do I then engage Fred and Zach?
So I
Just
have
want to make sure
another,
I understand, there's a certain flow and how it would work best.
yeah, I have another document we'll go over getting started. It's in that folder and we'll look at it together. It's gonna, the show, I try to keep these things short, you guys. I'm sorry if I'm long-winded, but there's so much stuff here. It's so, anyways. Yeah, and if we don't get to it or if you have to log off, Alex, there's a document in there getting started.
Okay, I'm here. I'm not going anywhere yet.
All right. If the non-working spouse wants to qualify as a real estate professional while working part-time elsewhere, the amount of hours spent outside real estate cannot exceed the hours of spent inside of real estate because the real estate hours must be more than 50% of the total working time. Practical implications: if the spouse works part-time in a non-real estate job, the time spent in that job reduces the percentage of time available. It's all the stuff we just talked about, but I tried to put some bullet points together for you guys so you could see it from different perspectives. For example, if the spouse works 20 hours per week, 1,040 per year outside real estate, they would need to work more than 1,040 per year in real estate to pass the 50% test. Fred, can you enumerate on that 50% test? So if they're working, running the practice or a part-time job elsewhere, they're logging 10 hours a week or 14, let's just say they're logging 15 hours a week, they have to work 15 hours a week or more in real estate?
Essentially, yeah, it has to be more time because they're going to want to see more time allocated to the real estate to make that your active real income. So, it's all about just some real quick background. Before this, I was an auditor at a company called Deloitte. Something with audits is it's all about your documentation. So if you ever were audited, it's what you're going to show them, why you're going to basically prove that, yes, I did work 50% of my time. Here's the logs, here's the dates, here's some examples of like what I worked on that day. And so basically it would be, yes, 50% of your time would have to go towards real estate.
So here's the best answer. And getting back to Alex's question a second ago, you find the clients and the cost segregation is the thing that moves all the benefit into year one of the property ownership. Zach on the pod right now with us, and also in the outline, I'll show you his contact info in a second, will get you cost seg studies for free. He'll do a perform a summary. You nail the doctor, you nail the high income earner. Fred can come up with the strategy. The strategy is just the stuff we talked about, but they always have corner case ideas or example, or not examples, but things they want you to answer questions on. That's when you plug in Fred. Zach is the first go-to to get the cost seg performa, because that's what accelerates all the depreciation into year one. And he's on the pod, and I'll give you his links. Summary: no set fixed maximum part-time workers disqualify the real estate professional by itself, but you have to meet that 50% test. And you, like Fred said, you keep logs to document your time. This is a strict IRS test, so part-time work must be balanced carefully to maintain real estate professional status. Consulting a tax professional is highly recommended for precise individual assessment. Don't get too in the weeds on your marketing. The marketing is just broad. Get them in the net, and then you can start weeding through the ones that shouldn't be in there and the ones that should. Key facts and bullets. One spouse can qualify as a real estate professional by devoting 750 hours plus to managing rentals that qualify. We're going back now to the spouses, income earner, high income earner, and one is part-time or not employed working on the rental properties, qualifying as an REP. Rentals that qualify as active business losses can offset W-2 income when filing jointly. Activities that account include property management, repairs, tenant communication, and improvements. This strategy is particularly powerful for high-income, one-income households seeking to reduce federal taxes. Maintaining detailed records at the time is essential to substantiate your REP status. Now, getting back to Alex's question, there is a OBBBA, how to get started. That's an outline. And then I wanted to also, while everybody was here, I wanted to go over the case study. Can you see this screen, Ryan?
Yep.
We've had a lot of infographics and things like that. I wanted to make a really simple outline that kind of crystallized everything that you could use however you wanted to use it, or just use it for your own reference. A physician earns $500,000 a year, buys a $350,000 Florida rental condo after July 9th, 2025. That date is essential, and puts approximately $100,000 in real dollars in their pocket in year one. For a $350,000 Florida condo, a typical cost segregation study can reclassify 20 to 39% of the building's depreciable basis into 5, 7, and 15-year assets, and make it eligible for 100% bonus depreciation under OBBA for property placed in service after July 19th. This means the first year accelerated depreciation would generally be in the ballpark of $70,000 to $136,500, and more expensive condos yield bigger tax offsets. Don't miss this opportunity. The Sunshine State is where it's at. So that's just an example of something that you guys could cut and paste and send if your client has more questions. How to get started. This was Alex's question from earlier. I feel like we could do a year on this stuff, but I don't want you guys to get bored of it.
This has been gold, Jim.
You can see the how I get started, Ryan?
Yep.
All right. I can't get it to shrink. Anyways. Contact a real estate agent and locate a property. Get a sample cost seg study from a cost seg consultant. Send the cost seg study to a CPA who understands the rules and can discuss. Purchase a property, own it for at least a year. Pocket the cash and taxes you don't pay. Sell, buy in a 1031 next year. Do it all again year after year. If agents lever this strategy, you're going to get a high income earner into your pipe that's going to have incentive to sell and buy every year. Or even if they don't sell, they won't get the big, huge cost depreciation. They'll buy another property next year. And they're gonna do it year after year after year. Unlike many acts, this particular OBBBA Act does not have a sunset provision in it. And it's the end of the year. People are looking for these strategies. You send out your content and you do this and you get in your net, you get in your funnel. Some of these doctors, these high income earners, they're going to need this benefit year after year after year. So this stuff is going to be reoccurring income for you guys. And I've said it before, if you have 20 people you get properties for, next year you're going to have 20 repeat sales for people that need more properties. It's 20 reoccurring transactions a year where you already have
Incredible.
this stuff nailed down. Now, here's the other opportunity, and this is what I'm trying to get agents to wrap their head around. If you have a person, if you have a property owner, and I fall into this category, and I call them dog condos. If you have a property owner with a dog condo, and you have another person with a dog condo, did I do an outline on it?
You got the cartoon, the condominium exchange cartoon. There you go.
You can take a taxpayer with a $350,000 condo and a taxpayer with a $400,000 condo. The 350 guy sells to the 400 guy, and the 400 guy sells to the 350 guy or woman. I should erase that last 45 seconds. I'm sorry I said that. The owners sell to each other. Don't burn me at the stake, you guys. The owners sell to each other, and I can see Australia is already sticking the pins in the gym doll. And now, because they did it after July 19th, 2025, my dog condo now made me 100 grand. I'm going to meet with my real estate agent that has a property listed with me this morning. I'm going to try to get her to wrap her head around this stuff. This is gold, because I would do this in a second if I could find somebody to do it with. And it could be a simultaneous closing. For those of you who know what a simultaneous closing is, you're just going to bring the differential cash to the table. And so, there's huge opportunity here.
I mean, let me ask you, could you do it again the next year? Could you guys swap back the same property back again next year?
I'm not going to dip my toe in that pool. That's up
Fred,
to
Fred, can you chime in?
No, you can't.
That looks
That's not gonna
that's
work.
that could be too many red flags then.
But Jim could sell to Ryan, Ryan could sell to Alex, Alex could sell to Fred, and Fred could sell to Jim, and then the next year we could do it again. And like we've said in the past, there's a reason why car washes, stadiums, dry cleaners change hands so frequently. It's all because of cost segregation. How many times have we seen the fairgrounds with new seats, the fairgrounds amphitheater with new seats and a new name? How many times have we seen the Miami downtown arena? It just got renamed again. It's all because of cost segregation. They refit the property, they get the accelerated depreciation. I'm sure all those, we're getting now into the asset classes. I'm sure all those seats in the stadium are considered high wear items. They go in, they put in new seats, and they rebrand it, they sell it, and now the new owner gets the huge cost segregate. They get advertising, they get promotion, they get cost segregation benefits. This is an opportunity for small investors to reap those same benefits. And we talk about $300,000 or $400,000, $500,000 income. You can do it if you have $100,000 in income. You don't have to be a huge income earner for this stuff to work, but huge income earner, big income earners are going to be a lot more motivated to do this stuff before the end of the year.
Jim, I just want to say one thing because I do have to go because I had an 11.
Yep.
But something, and I'll leave on this note, and maybe we'll talk about it more in the future. Something Jim just reminded me about is all of those places he just said, a lot of them are businesses. So, and he might know where I'm going with this because I've said this to him before. The businesses that own real estate are automatically considered active income. So remember, business owners have to depreciate their real estate. So if they get a cost segregation study done on the real estate they own through their business, they don't even have to worry about the passive to active rules. It's going to automatically flow through the profit and loss statement on the business return. That's something definitely we could talk about probably more in the future, though.
So that's Alex's question. You get the business owner, you get the HVAC owner, you get the carpet cleaner, you get the somebody with a bunch of assets, and additionally somebody who owns other real properties in their assets, but all of it, cars, you know, but the real property is what we're talking about. But typically, when you do have the HVAC owner, you know, the air conditioning company owner that has assets and income, they own real property. That's a call to Zach, and he does a quick pro forma on all the addresses.
Yep.
And then look at the first year benefit and the first year benefit real quick. Zach, what's your turnaround time on a cost seg, like a pro forma cost seg? Oh, he may have logged off. He gets them back quick. I think it's within hours, but it's certainly within a day.
Yeah, he can do it within a day.
I'm going to go back to our outline just for a second. Case study. Oh, big, beautiful bill. Outline. Can you see the outline, Ryan?
Yep.
So here at the very end of the main topic, here's contact information for Fred. Here's contact information for Zach, their websites, their emails. You guys can call them, contact them directly, and do what you need to do for your clients through them. Want to wrap up real quick here. It's 11:08. I apologize for holding everybody over. RealTrade. Awesome product, social media for real estate, home of the double dip. What can I say? Ryan's leading with the chin. This is the way real estate's going to go. It's just a matter of time. Agents are sick and tired of getting fleeced by Zillow and sick and tired of getting fleeced by the other platforms for participation. Ryan fleeces the vendors, so you guys work for
Zack and Fred pay for you guys for your free leads, so check them out. I shared their profiles on the chat, but yeah, it is. Guys, it's free for agents to join. You get free leads
the
off
way
your
it should be.
yeah, and then you can get connected with awesome service providers that we all need, right, to help our business, just like we did in this webinar. So, and we're growing now. We got some great new features that we have that we just launched, which is the first look feature where you can upload listings directly onto RealTrade. So we obviously suck them over from the MLS from you, but you can also upload other stuff too before it goes onto the MLS onto RealTrade. So that's pretty awesome, which I've gotten some good leads from that, some listings that I put on there. So
New path title, you guys need attorney support, click here. You need a title advance, click here. You want to go out and get something a little bit more advanced than a title advance. You can get an actual commitment. I want to stress to you guys, you click on order title products. If you order a title insurance commitment, I will pay you back for the commitment at closing. It's $175. You get a complicated property with all kinds of issues. You click the commitment. You'll get that early on in the transaction. You'll get that title agent perspective, not just the title advance, but the commitment. I'll pay you back at the closing table if you pay for it or the seller pays for it when you guys close the property. And title advances lives on its own. You just go there and enter your address. We're revamping the way we're delivering them, and so we're going through a little growing pain, but Scott's getting them out, and all you gotta give us is a property address, and that's it. Tell us your role in the transaction. A couple of you agents have been taking advantage of our hard money lending, so we have a company, TO Capital, TIO Capital. TO Capital is a hard money lender, and I love paying points to agents when we close. So you guys bring us a borrower, and we just cut a check to a real estate agent at the closing we did last week, $12,000, 2 points, $600,000 loan. Let's make it rain, you guys, together.
wow, awesome. Well, thanks, Jim. I mean, gosh, this has been a heck of a series, guys. You know, with the OBB, you know, the one big beautiful bill. I mean, as we can see now, we're we're not just selling real estate, we're selling tax advantages, guys. You know what I mean? Which gets them to buy real estate, which obviously puts commissions in our pocket, and people save money and they invest in real estate and stuff for it. I mean, it really can't get much better than that, Jim.
So what I'd like to do is take a break from OBBBA for a week.
Yep.
We'll talk about, and if you guys have any ideas, I want you to text me your ideas, but we'll talk next week. 2 weeks from now, we'll talk about pad split, implications in the market, what's going on, and then we'll have a guest. Hopefully we'll have the guest speaker, and then we'll come up with another topic. But you guys keep your input coming to me so I can provide you guys what is most valuable to you.
Awesome. Thanks,
All
Jim.
right. My pleasure.
Everyone.